This is a production of the Michael Parsons Trading Institute. All rights are reserved. Disclaimer required by the CFTC. If you risk it, you can lose it. ReversalMagic.com presents the Reversal Magic video course. The power to predict, the power to profit. Reversal Magic Training Video number 5. Making the Trade. Without question, reversal magic is an extremely powerful technique for trading the markets. But when all is said and done, the real question, the real issue, is whether or not you can trade it to make money. Even though we've seen some extremely powerful signals with reversal magic, the reality still boils down to how an individual interprets those signals and how they use them. Because a signal is useless to an individual who simply does not know how to utilize it. This is what this next series will deal with: how to actually make a trade, how to use reversal magic to find the trade, enter the trade, and actually exit the trade for a profit. As we look at the signals that we've just generated, we have some very powerful ones, like this reversal right here. A great buy opportunity because it's the extreme of the market. The market fell considerably, and right at this point it was a great buy for an uptrend. However, this particular signal might be a little bit much for the beginning trader, the person who's just starting out using reversal magic. You see, even though we have the ability to sell extremes and buy extremes, well, beginning, it's not advisable. The fact is that it's always best to trade with the prevalent trend. And if you look at the situation, the market had been in a downtrend up until this point. This would have been a great exit point to take profits. But until the channel was actually broken and the trend changed, as we see right here, well, then it's not advisable to actually buy into the market. The perfect buy would have been over here in this reversal signal, where the market had already broken the trend line and had come back and set up a buy opportunity where it found support on that trend line, moving higher and creating a great profit opportunity. The reason for this is that it's, first off, less taxing on your emotions. Secondly, it's conservative and has less risk involved. Let me repeat this point for emphasis. Entering an extreme reversal presents an extreme emotional challenge. Now, what do I mean by that? Well, let's take a look at this extreme reversal that we had down here. Beautiful buy opportunity. When you look at it and consider the fact, there are two aspects to consider here, emotionally. First off, note the rapid decline in the market, almost in free fall. To actually consider buying off a market like this is a very scary proposition. Demands a lot emotionally. But that's not all. What is the typical characteristic of a reversal bar? Well, quite often you will see it spike like you do these bars. And the result is that it looks like, or gives the appearance, that the market is rapidly moving against the trade you want to make. No less is this true of this bar. In fact, let's examine a little closer, and what do we see? The bar opens up high and proceeds to fall and decline. Even when it closes, it is well below prior bars. So it does give the appearance that the market is still strongly declining. It's not till a couple of bars later that it becomes clear that a reversal has actually occurred. When you're trying to buy in a rapidly declining market, there's a lot demanded from you emotionally. And while this is the absolute goal of anyone using reversal magic, and eventually we're confident you will be able to do that, initially it's going to be rather difficult. It's going to require that you gain confidence in the method. But there are ways to trade conservatively and have confirmation while still taking advantage of the reversal. One major reason for not trading extremes, at least as a beginner, is that unless you have the correct reversal in a strong trend, well, you can actually cost yourself a considerable amount of money. Let's go back and look at this extreme. While we have clearly identified the reversal, that's the correct one, and it's fairly easy because we have two good points. Not every market's going to be this simple. Sometimes we may choose the wrong points. For example, this series of points, which are themselves, they're strong, widely separated, and should provide a nice, good reversal. Yet the signal provided, well, all it does reverse the market momentarily, but it's just a pause. One bar goes back or higher, and then it promptly resumes the trend. Obviously, anyone buying on that bar, well, they would have had an issue 2 days later. The reason is that unless you have the correct reversal and identify that, well, this may be all that you get inside of a strong trend. It's just going to pause or slow down the market before it resumes. Therefore, as a beginner, it's best to avoid fighting the prevailing trend. Eventually, your skill will develop to a point or level where you'll be able to identify those extremes without a problem. But until that time, it's best to use the reversals on a conservative level. Work with them inside of the trend. Sell the reversal highs and exit out the reversal lows in a downtrend. Buy the reversal lows and exit out on reversal highs on an uptrend. As simple as that. So let us now focus on some conservative entries that even a beginner can use. We can use a reversal to signal 1. The end of a prevailing trend's pullback. 2. An entry near support or resistance levels. 3. An entry off of a channel line. 4. To sell the top or buy the bottom of a trading range. 5. To enter following a top or bottom pattern. If you have been trading any length of time, then you probably have heard the expression, the trend is your friend. In other words, the market wisdom is that in whatever direction the market is moving, that is the direction you want to trade. If it's rising, you want to buy. If it's falling, you want to sell. Identifying a trend, particularly if it's already begun and operated for a little while, is not difficult. Even here, we're using nothing more than the 18-bar moving average to indicate the trend. As the market price begins to fall and remain below the line, we know that the trend is downward. And so, following market wisdom, we would want to sell, not buy. The problem with this is that most people identify a trend at the same time. In other words, as this market began to fall here, there were a lot of people who recognized the trend at this point and sold at that point. How did the market respond? Well, it made a pullback, as you can see here. A similar situation occurred here. People began to see another trend form and sold here, and the market pulled back. Both of these cases present a situation where it can scare a lot of traders out because of fear that the market's going against them, and of course lose money in response. How much better it would be to actually short or sell the market right at the point that the market ends its pullback and starts the resumption of the trend. How can you do that? Again, by using reversal magic. The first thing, of course, is to identify the prevailing trend, and this is clear. This is downward. The second is that a pullback is in operation, as you see here, or you see here. Then you locate the reversal to indicate when that pullback will end. Example can be seen here when we triangulate these points and we come up with this reversal right here, thereby indicating that this is where we would want to sell the market. As you can see, anyone who took that signal made a nice little profit. So this is a trade, a conservative entry, that anyone, including a beginner, can use. Another great conservative entry is that of using a reversal near a significant support or resistance level. An example can be seen in this market, which is cotton, how the market rises up to set a high here at 57.5 and then draws off of that. Every time the market returns to that price level that we have set as a dotted black line, well, typically we can expect a reaction. Find a reversal high at that level and you have a great sell opportunity. Now bear in mind that support and resistance levels are typically more of a zone or a narrow band rather than a set price level. Even here you will see a secondary high at 57, about 50 cents difference. And you'll see that typically on other highs and lows that occur, a difference of a range of approximately the same amount. So if you have any question as to how much range to allow, look at other highs and lows and the secondary points that may be a little higher or lower than them and see how much difference you have. From here, you can look at any time that price returns to that zone as a sell or buy opportunity. Just simply find the reversal that matches. So as we move this chart over, we can look at a couple of other examples where price again returned to the same zone level as we see right here. Find a reversal high and you have the opportunity to sell this market at just the right time. Examples right here. We have a high and it's right within that zone. Great sell opportunity, as you can see here. You can repeat this for every time price returns. Again, here's another point where price reaches that level. Find a reversal high and you have a great sell opportunity once again. The market reacts very strongly off of that. Return to the next one, do the same thing. No matter how many times price returns to that level, simply find the reversal high and sell. Because it doesn't matter how often it occurs, all it takes is locating the reversal. And you have a great sell opportunity. So take advantage of these reversals, particularly anywhere near you find significant support and resistance levels. They are a great conservative entry and exit point. One of the best ways to trade is by using channels, and this methodology is outlined in the book and course of Channel Surfing. Here is an example using the 30-year T-bond on a monthly scale. You can see the long-term trend that we have and how it's outlined by channel. Every time the market draws close to bounce off this channel line that's expected to be support, looking for a reversal low is a great trade opportunity to buy into the market and take advantage of the overall trend. All you do is simply find the reversals that are appropriate. For example, here we have a low, creating a great buy opportunity. Later on we have another reversal that we can use right here, creating another great buy opportunity right here. You see, each time price draws close to this channel line and you have a reversal low, it provides a terrific buy opportunity that allows us to profit very well for the market. Using the two in conjunction is a great conservative way of trading the markets using reversals. Another conservative entry is using a reversal to sell the top or buy the bottom of a significant trading range. By the term significant, we mean that there's enough distance between the high and low to allow enough profit to overcome any risk you accept. Now this sounds similar to that of selling and buying near significant support and resistance levels as we discussed earlier. The difference is that trading ranges tend to fall in an area that's within the general activity of the market, and they set highs and lows that are similar, so they do provide an opportunity for trading, but you don't have the advantage of significant support or resistance. Just as we did earlier with significant support and resistance levels, we have to establish an upper and lower zone that we're going to buy and sell off of. That is established by looking at the highs and looking for a secondary point that establishes a zone. For example, here we have a clear high. The market rises up and begins to fall here, and we see where the bar closes higher. So even though we spike initially earlier, we can see clearly the price reaches an end in its motion right at this point, creating a zone running from 136.70 to 136.80 plus. Now, there's a little bit wide of a zone, but it's a zone nonetheless. Looking on the other end, we establish a lower zone, and we do have a zone, this price level set here at 135.85. If we look at the bars and where they close and the majority of price activity, we find that we have a zone that basically is within this area, 135.90. So we set a zone that's much narrower than the upper zone, but a zone nonetheless. From here, it's just a matter of finding reversals that fit within those zones. Since we already have two lows established, and this is one of the tricks that you want to look for, do two lows or two highs form similar price levels? If they do, then likely you're within a trading range. Having that established, you simply are looking for a high reversal within the zone. A reversal here was established right at this point, and we have a reversal that establishes a sell point that touches that lower end of that zone. If you miss this reversal, then of course you simply look for the next available one within the zone that's a reversal high. And we have one established here that sets our reversal right here. And again, we have a sell right within this zone. And on the opposite end, we look for a similar situation, a reversal low that's in the zone. And here we see an example where the price is a little short of the zone, but close enough to establish it's right within that vicinity with a reversal. So here we can see 3 trade points: a sell, and a buy established by simply using the high and low zones, and a reversal to signal the actual point of entry. A final conservative entry is that of a failure to exceed a prior high or low. This is also known as the 1-2-3 pattern, and many beginners learn to trade this pattern. The basic concept is this: the market sets a high or low, and that is called the 1 point. It draws off of that, creating an opposing point, and that is your 2 point. The market attempts to reach back up to that prior high or low, and fails to reach it. In this case, it fails to come up as high, and that is considered your 3 point. On the normal procedure of trading this pattern, basic concept is that once it exceeds the 2 point, then a position is taken. In this case, it would be a sell point. The problem with the pattern is, of course, that the other market can come right back up to where it originally was at, creating a substantial drawdown and risk. Imagine for a moment, though, if you were to trade this pattern and actually have the reversal as to where the 3 point ended and actually entered at that point. In this case, this market of coffee, you can see that it would have resulted in a substantial profit opportunity. But how do you do that? The key to this trade is in locating a large wave reversal signal that coincides with the recent major high or low, which in turn implies that a trend change is likely. Before we talk about the specifics of that, we need to clarify and be absolutely clear about one important point in regard to this pattern. This is a failure. Your second point that you're using to enter a trade cannot match or exceed the first point. In this case, this high is higher than the high that we're using for a trade, so therefore it qualifies. If it matched or exceeded it, then the trade would be void. It's important to recognize this specific point, because if you do not qualify this pattern, well, then you could end up with a failure in the trade. So let's talk about the specifics of locating a large wave reversal signal. The first consideration is the actual location of the major reversal signal. You see, we have 2 points where the major reversal signal can occur: the actual high or low that we're using as a reference point, or the actual point that we would look to enter, which fails to exceed the prior high or low. Obviously, if a major reversal signal occurs at the point that we would enter the market, well, then we don't need any other signal. We have the pattern itself that establishes the trade. However, if the signal occurs at the point of the major high or low that is being used as reference, then we must, of course, have still a reversal signal to enter the market. It just doesn't have to be as strong. Any well-defined signal will do. The key point here, though, is that this major reversal signal must occur at one of these locations. If it does not occur in line with one of these points, well, then again, the trade is a bust. So let's see how we would locate a major reversal signal. The best source of a major reversal signal is going to be a larger wave pattern. And sometimes you go to a higher time frame, sometimes it's just a matter of increasing the size or pattern to condense the chart so that you can see more data. A reversal signal can be anything that is clearly a large pattern, such as these 2 points along with this high. And by doing that, we coincide with a reversal over here. And when we bring this back together, we can find the reversal signal located right here. Now, this was a prior high or low that we failed to exceed, and you can see the reversal signal right on time, setting up the short in the market or the sell, establishing a very fine trade. This is an example how you would use a failure to exceed a prior high or low and a reversal, that's a major reversal, to establish a conservative trade entry. In summary, conservative entries include using reversal to signal 1. The end of a prevailing trend's pullback. 2. To enter near support or resistance levels. 3. To enter off of a channel line. 4. To sell the top or buy the bottom of a trading range. 5. To enter following a top or bottom pattern. And 6. To enter on the failure to exceed a prior high or low. An important consideration before entering any trade based on a reversal signal is how soon the next reversal will follow. Another consideration is if multiple reversal signals are within close proximity to one another. The answer to these questions can dramatically impact your trading effectiveness. A reversal signal that follows in very close proximity to the signal you're looking at will generally negate that reversal signal. To give you an example, let's consider this market, which is Microsoft. If we triangulate a couple of reversals that are very strong, such as this one here and this one here off these points, and we triangulate both of them with a similar low as we see here, we get two signals that are in close proximity to one another. The result is you end up with a reversal here and a reversal here, just 2 days apart. The end result is that you end up with a high here that quickly drops for 2 days, but then reverses right here to move higher off that signal. The problem, of course, is this whipsaw effect can really create havoc in your trading. So it's usually best to pay attention or focus on this last reversal that you're dealing with in close proximity. Look for reversals that have some distance apart, not excessively so, but a little distance to allow the market enough time to actually move, and thereby profit more. And of course we want to be cautious about multiple reversal signals that are within close proximity of one another, because they tend to imply consolidation patterns and trading ranges. Here in this market of Microsoft, we can see a number of large wave patterns that all triangulate close together. And the multiplicity of these signals means that, well, the market doesn't have much opportunity to move. As is implied, we see a consolidation is what occurs. So wait till the consolidation breaks out, wait till these signals start to break up and have some space between them. Take the last signal available and use that as a source of your signal to trade. But avoid these that are in close proximity to one another. An important part of any trade entry is that of setting a stop limit. At any time, a catastrophic event can occur, causing the market to go against you, and thereby you can sustain substantial losses if you do not set up or make an arrangement for the market to get you out when such an event occurs. The thing is that setting a stop is, well, oftentimes a skill and an art. But here are some tips and tricks to using stops in regard to reversals that will aid you in doing this successfully and having them work with you rather than against you. When it comes to setting a stop, from a theoretical standpoint, the actual high or low of the reversal bar really is the limit of the market. And so technically, that's what you have as a stop. In a real trading environment, this is not practical. Let's look at some considerations as we look at the actual application of a reversal. Say this is a reversal right here, and if we set a low just at that point, then typically we would expect price not to be exceeded. But remember, we set an order based on what price we want the market to get us out. In this case, it would be at 1502.5. The reality is that it's not uncommon for a price bar to match the actual low or high, yet still not exceed it. We see an example right here. The price bar came down, matched the same low, and of course just continued upward. In spite of that, because it hit the actual price, if our stop limit was set at that price, 1502.50, guess what would happen? We would be out of the market. So therefore you cannot set it at the actual price, but must extend it a little further beyond that. Additionally, as we learned earlier, there are various waves within a market, and it's not uncommon for a rogue wave to create a spike right at a high or low, even though it may have already followed a reversal signal. An example can be seen here. Here we have a reversal signal, and you can see how beautifully the market declined following that. Great profit opportunity. Yet note, just right after this reversal signal, this one bar spiked a little higher before it declined. Obviously then, if you had a stop set too close, you would have missed out on much of this profit. How, though, do you allow for this action or this erratic behavior of the market? It's a simple matter of looking at other highs and lows and see what the average spike is. Here you can see where the market is spiked about 2 points worth. And a similar situation here, about 2 points worth. Now, whatever market you're trading, you will see that there's an average that you can count on that the market will spike a maximum of. So simply take that and calculate that within your actual high. Here we have a high of at approximately 1532 1/4. So we simply set this at 1534 1/4. This would act as our stop. Now, once the market begins to move in your favor, the last thing you want to do is just leave the stop where you initially set it. It needs to be advanced according to the market and the way the market will allow. Now, many people will use highs or lows that are established by a trend as it's moving in their favor. For example, in this downtrend, every time a high set, well, then a stop would be set just above it. Every time a high set, a stop would be set just above it, and so on as it proceeds lower. And if the market should ever move back up, as it does here, well, then it would get you out of the market at that point or that level. The key here is that you wouldn't lose all the profit. The fact of the matter is that while that works in many cases, it is not the most efficient way, and the most dynamic way is to use channel surfing. So we strongly encourage you to learn channel surfing and use it to apply your stops dynamically and to manage the trade. While entries are very important to a trade, the opposite side of the coin, the exit, can be even more important, because that's what you use to lock in your profit. A mismanagement of exits can really be catastrophic. The question is, what do we use to signal an exit? Well, there are three things that we're going to consider. The first is the obvious one, the stop. When we set a stop because of a reversal, and the market, whether it moves in our favor or not, exceeds that stop, well, then obviously we need to get out. It's not something that can be ignored. No matter how great the loss may be, do not ignore a stop. It is your protection from catastrophic losses. So the first rule is that a stop limit, when it's exceeded, it's time to get out. The second signal to exit is when you have a market move against you, and yet the next available reversal, well, is still quite a ways off. An example can be seen in this market, or this stock, Exxon. We can see it moving up very nicely, great profit opportunity for anyone who bought. But then we start to see this decline, and it clearly indicates that the market's in trouble. Yet the available reversal, well, is still several days off, meaning that this market, well, it could accumulate quite a bit of losses before it finishes out and turns around to move higher. Seeing this should be a signal or indication that it's time to get out, lock in your profits, and wait till the reversal signal arrives to actually buy again, thereby adding to your profits or increasing your bottom line. And finally, an exit is taken if a reversal occurs while the market is advancing in your favor. This is also known as a profit-taking exit, and it's the key exit that we want to take to make the most money. An example can be seen here. If we triangulate a couple of points and determine a reversal, we end up with a signal here, which of course gives us a reversal right here. The market's proceeding lower. We reach the signal. What is the expectation? Well, that is going to reverse and go the opposite direction. So therefore, we want to take this signal and exit out on it and use that to lock in our profits at the very maximum that we possibly can. This again is called or referred to as a profit-taking exit. There is one matter of clarification we want to make in regard to exits, and that's when not to take them. If you have a reversal due very soon, Even though a market seems to be breaking against you, it may be well worth your while to hold on to that position until the reversal arrives. An example can be seen here in the US dollar. We triangulate a couple of points and we determine a reversal that's located here. If you're using a trend line or whatever means to determine that a market is starting to work against you, then obviously it's working against you right here. And yet if it broke this day and the next day has a reversal, well then you would expect what? A high, and that the market would resume the trend, which is exactly what it does. Allowing a little extra time for the reversal to arrive, if it's that close, is well worth the effort, and it pays off in huge dividends, as you can see here. So if you are close to reversal, and the market seems to falter or starting to work against you, well, if it's very close, give the reversal an opportunity to work. It may indeed work in your favor in a very profitable way. As you look at this chart of the Australian dollar, what reversals stand out as the ones that you would like to be able to locate? If you're like most people, you would say the extreme highs and lows that provide the greatest profit opportunity. Of course, all reversals are important, but these are the ideal that using this method we want to achieve. The fact is that we can actually do that. We can identify the strongest reversals by identifying the strongest wave patterns. In fact, there are many swings that give away exactly where to locate the very end of its swing, and that has to do with the balance point. A balance point is, as its name implies, it's a central point of the swing. It is often characterized by a point of indecision. Sometimes it's a very wide pattern, sometimes narrow, sometimes it's characterized by a gap. But in most cases, it is characterized by a wide consolidated pattern. An example can be seen with this swing here. If you look at it, you see where the market makes a pullback, drops back down, and even attempts to come back up again, creating a slice in the division of the swing. This is a balance point. Another balance point exists right here, where the market made an effort to rise and then fall and then rise again. The consolidation, or point of indecision, is the balance point. Another balance point is found right here, where the market drops and it consolidated for a while and then dropped again. These are just a few examples of a balance point, and these are key points when used either with the prior high or low, can often give you the exact end of the swing. So let's see some of these reversals in action. We take a prior high, triangulate it with the balance point, and we end up with the reversal low. Just as simple as that. We can do the next one using the prior low and triangulate with that, and we end up with reversal high right on time once again. Now we can repeat this process over and over. Now, not in every case will it work out perfectly, but typically the balance point will be the key to the end of the swing. The key is, of course, being able to identify it. In many cases that's simple. You see a wide pattern or something developed that is a point of indecision, and you have your basis for developing the reversal signal. If it's not there, well then you will have to locate it through other standard means, such as a larger wave pattern. In any event, take advantage of these easier ones to locate by locating the balance point. An important concept to learn is that of verification. Wave patterns themselves typically are not going to be an issue, but there are times, because of so many wave patterns in the market, that you can choose the absolutely wrong points. A situation where the waveform actually conflicts with itself, resulting in an accurate reversal. In other words, you basically have a reversal signal that does nothing for you. The market just keeps on moving. That, of course, is something we want to avoid. And you can avoid the majority of those cases simply by verifying that you have a solid wave pattern. How do you do that? Well, simply take a wave pattern that you're looking at, for example, these two lows that I'm looking at that have a nice pattern, and I would expect to provide a good reversal, and use prior points that actually precede your secondary or last point you're using for the triangle. An example would be this high over here. Now, it can also be lows as well as highs. All you're doing is looking for some type of reaction at the market at the point that they intersect. And you see an example here. We see the pattern reversed, or the market reversed, right at that point in time. Even though it's prior and it's not much use to us in the future, it is of value in verifying that any reversal we determine off of this pattern for the future will indeed be accurate. And we can use this as an example. Well, we determine a reversal, for example, right here. And you can see where the reversal occurs right on time. This is a way of determining the accuracy of the wave pattern, and it keeps you out of trouble when avoiding those missed signals that occasionally will show up because you've chosen the wrong points. Do you trade the Forex? Well, if you do, then you know that it is a very erratic market, and it's understandable because you're dealing with not just one market, but two that are paired together, which in turn means you have not just a normal amount of waves, but twice as many. Well, obviously that creates a more complex market. So there's some special considerations that we're going to talk about in regard to trading the Forex or any other complex market. One of the first considerations is simply the realization that because you're using two markets, there is absolutely nothing that prevents you from going to the individual markets to determine a reversal and using it. In this market, before us, the Forex, we have the British pound and US dollar. So we have the ability to go to the British pound chart, whether it be a futures chart or whatever chart you're using for the individual currency, and determine a reversal and apply it here. We can do the same thing with the US dollar and apply that reversal here as well. Well, let's take a look at an example. We go to the US dollar, we have a reversal, as you can see right here, and the time of the reversal right here, which turns out to be the February the 5th, 2007. We have a nice decline, but for the most part, initially it's just a short duration reversal. And it's important to note that no matter how strong the reversal is in the individual market, you are dealing with two markets in the Forex. So it may not be as strong, then again it may be stronger in the Forex market. But the fact is a reversal still should occur. Going back to the Forex market, we simply go to the 5th of February to match our reversal, and sure enough, as you can see, a reversal does in fact occur. This trick and this technique can be used very easily with any individual market and applied to the Forex. Ideally, if you determine reversals in both markets, such as the British pound and US dollar, and apply it to the Forex chart of the British pound against the dollar, you'll have much more accurate and powerful reversals. Coordinating the two works very well in determining the best moves or swings in the Forex. And this is a simple yet effective technique for accurate reversals in the Forex. Another important consideration when it comes to the Forex is the time that you actually trade. Remember, the Forex market is traded around the world, and as the hours change, you're going to change the market participants. At one point in time, there will be those in Asia that are trading the market. Later on, it'll be those in Europe, and then even later on still, those in America. As these changes take place, well, there's going to be a transition in the view. Additionally, in between each point, there's going to be a lull that takes place as well, where very little activity occurs. Example can be seen here, where you see from about 1500, 1400 hour to 1 o'clock, 2 o'clock, that the market's kind of dead with very little activity. What a contrast when you compare it to this move or this swing here. If you look back further again, you see a similar situation, 1 o'clock going back to 10, 14, 12, etc., where the market's dead again. And that is repeated time and time again. Here's another example of from 1 o'clock back. You have to look at your particular time zone and compare it, but avoid these times whenever possible, because they are going to be the ones that create havoc with your account. Look for the times when the market tends to really move and swing, where the trends develop, and where you can anticipate a much larger move. And these, of course, are going to be times when participants are trading the market. As a trader of the Forex, it helps to appreciate that this market is prone to extremes, even if it's not going anywhere. To show you what I mean, take a look at this trading range in the British pound and US dollar. Even though it's not really trending higher or lower, you see a lot of spikes that occur within the market. In fact, the majority of bars have some type of spike. And by spike we mean that if you look at the body of the bar where most of the participation takes place, that will be seen by the green and red bars, the spikes that extend upward or downward are very short-lived duration trading that goes to extremes, and yet many of them are as long or longer as the main body of the bar that's in red or green. This demonstrates what is frequently referred to as noise in the market. Noise of itself, well, it's just that. It doesn't really have a lot of strength. And particularly when you're dealing with a trading range of some sort or any consolidation pattern, these spikes tend to provide very weak signals in regard to reversals. If it's trending up or down, well, typically they're not going to be an issue. But while the market's consolidating, these spikes can fool you into thinking you have a solid reversal, and yet in reality have nothing at all. The key then is to filter this when it's necessary. And there are two approaches that we can use to filter these spikes or the noise within the market. The first filtering method is by using high and low moving averages that refine the reversal signals. The second refining method or filtering method is to use the close of the bars. And we're going to be addressing both of them here. The first filtering method is that of a high and low moving average. If you look at this chart, you'll see that I have one green line and one red line. These two lines are nothing more than a moving average. And one is set at all highs, the other is set at all lows. If you want to know the setting that I'm using here, we simply look at the setting and you find that the upper moving average is nothing more than all highs set at 13-period moving average. Now, some markets you may have to optimize this and may go higher or lower. You may have 11, 12, 14, or 15, but generally 13 is a good starting point for optimization, and then look to see what result you have and adjust accordingly. The lower moving average in red is nothing more than all the lows set at 13-period again. Important point here. Whatever setting you decide upon to optimize your moving average, use the same on both, upper and lower. So how do we use the moving averages to filter out the noise and extremes? The moving averages act as a substitute for your diagonal lines. Let me show you what I mean. First off, let's consider a couple of reversals that we see on the market using the standard method of determining reversal. When we look at this line, we come up with a very fine reversal. The market drops sharply. Here's one point that's lower, obviously a larger wave pattern, and yet when we look at the reversal, well, it's not much to look at. Yeah, there's some reaction there, but still rather weak. What happened here? Well, the answer is, if you look at this bar, this point, you end up with a reversal right here, much stronger. The reason is that this is the real low of the pattern that comes down and goes up. This bar, well, it had some noise attached to it and spiked down, giving the appearance that it's much more significant, but in reality was very weak, as you can see from the signal. So now let's compare those signals with the ones we would generate with the moving averages. Because the moving averages are the average and not the highs and lows, and this acts as a replacement for the diagonal line, we avoid the noise or the extremes. Therefore, whatever horizontal point we would use, even though it may be a spike, is already filtered and can be taken as it is. We simply connect the lows with the red or low moving average, and the highs with the high moving average. Let's take a couple of examples, the ones we've already used, and compare them. Here we have this low intersect with the moving average right here. And you can see that the market initially spiked higher, but then dropped back down to spike lower before moving off to higher ground. In addition, if we look at the other two, we intersect the moving average, the low moving average right here and here. And again, we see that the market created a little high and then dropped down and spiked lower on the second reversal signal just before it moved higher, for a great profit opportunity for anyone who bought there. You can do the same thing with highs. For example, we see a nice little swing here and a high that stands out that's secondary, but definitely significant. And when we triangulate this, well, we come out with a reversal right here. A clear and definite high that we can use to sell the market. So there are some advantages to using this filtering method. However, there are a couple of drawbacks. One, it will require optimization from time to time. Even if you have a good setting, markets change. So you may have to reevaluate that setting from time to time. Second, it doesn't have the same predictive quality as the standard method of determining reversal. You have to have the moving average hit that price level before you know definitely that that reversal is due. The market can actually have the moving average linger just below or above the line for some time before it actually hits it. So there's a definite advantage to using the standard method of determining reversals. However, it is user-friendly if you should decide that you want an indicator to tell you when a reversal is due. So there is an advantage or plus there. In most cases, the standard method of determining reversals are the best way to go because they give you the prediction as to when the reversals due. However, if you're in a consolidation and dealing with a noisy market, the filtering method here, by using moving averages, is a definite plus in being able to trade accurate reversals while trading the Forex. Another approach to filtering out the noise within the market is that of using the close-only chart, or what is commonly referred to as the line chart. As we look at the euro against the US dollar here in candlestick form, we can see a number of spikes that show. And yet if we switch that to a line chart, those spikes are no longer existent. In essence, by removing the highs and lows, you remove the noise, and in turn, the missed signals that may occur occasionally. Let's compare the two and see how the end result would be in determining a reversal. We use a couple of points that should provide a decent reversal, and when we triangulate these using the candlestick approach, or chart, we end up with a nice reversal here. A low that provided a great buy opportunity, and you can see the end result. Now let's compare this to the line chart. We'll use the same swings as we did with the other points in the candlestick chart, except in this case we are using just the closes and not the highs and lows. The end result is that we end up with a reversal here. And if we turn it back to a candlestick, you can see that indeed it was a great buy opportunity, in fact even better than our original one, providing not just half the swing, but the entire swing and profit opportunity. Now looking at this, one of the first questions that arise is, well, then why don't we use a close only all the time? The reason is because the close only will not provide you with every reversal signal, and therefore it is advisable to use the extremes whenever possible. It's when they become an issue, where noise becomes a problem that in turn provides false signals, that you would want to turn to using the close only method to filter out those signals. Now those reversal signals weren't bad at all, but let's move down this chart a little bit, and we notice that there's a little bit more noise. If you look, you'll see a consolidated pattern with spikes that are rather excessive for the short duration that they're dealing with, and you see this repeated again here. While the noise itself is something you'd have to learn to identify when it occurs, the fact is that it does impact the market reversals, and let's do a comparison on this area and see the difference. First off, we'll triangulate a reversal on the candlestick, using, again, a number of points that should provide a decent reversal. And when we triangulate it, we indeed do get a reversal signal. But if you look at it, well, it's not quite as strong as we would anticipate based on the size of the wave pattern. It is a reversal signal, and we can't complain about that fact. But again, it is not quite what we would be looking for that wave pattern. That fact in mind, let's compare that with what we would get on a line chart. Again, we'll use the same points as we did before, except this time we are just using the closes of the market to determine a reversal. And we end up with this point, and if we switch it back to candlestick, it really stands out of how good or high quality of a reversal this signal actually is. And you can see the decline as it's occurring. This fact emphasizes the quality of the close only. And the reason that it makes a difference here is, in fact, the noise that has developed and impacted the end result. So therefore, when you have an issue of noise, it is a good alternative to determining your reversals. Just do not use it as your primary method of determining reversals. It does provide perhaps the best method for signaling or for filtering out these false signals of any other method that we've demonstrated here. Reversal Magic Training Video number 5, Making the Trade. This is a production of the Michael Parsons Trading Institute. All rights are reserved.